Hi, I'm Liz Naumovski, host of Finance is Personal. The popularity of exchange-traded funds known as ETFs has increased over the last few years at a record-breaking rate, and they've become the most popular investment vehicle and are now used by investors and traders globally. Now, many of you have heard of ETFs and probably invested in them, but do you really understand what they are and why they've become so popular? Other than the fact that they're easy to use and are a low-cost way to invest your money, it's important to know what you're investing in and understanding how including ETFs in your financial plan can benefit your overall portfolio or not. According to a recent statistic as of September 2019, by 2030, 2/3 of wealth will be in the hands of women, with billions of dollars pouring into ETFs. It's crucial for the financial industry to continue to educate advisors and their investors so that they can attract and engage female investors. So joining me today to help us learn more about ETFs and why they've gained popularity is Pat Dunwoody, Executive Director of the Canadian ETF Association. Pat, thank you so much for coming.
Thank you.
So many myths, so many things, like so much information about ETFs out there. And I'm hoping that we're going to be able to uncover everything today within the next 24 minutes.
Sure.
No pressure. So we've heard a lot about ETFs in the media. Can you please explain what exactly an ETF is?
Sure. An ETF is basically a mutual fund with a different wrapper. So it's a manager taking a pool of investments, whether that's stocks or bonds or a combination thereof, and wrapping it, and then individual investors buy units of that pool of investments.
And basically, they are just traded like a stock on the exchange.
Yes, that's the main difference between a mutual fund is that it's this pool, but you buy it through a stock exchange.
So a lot of the times you hear, there's so much volatility in the markets right now. There is just so much going on, up, down, it goes from one extreme to the other. And a lot of people are reading in the news that ETFs are illiquid or the volatility is going to make them crash. Just can you explain to everyone whether that's a truth or a myth?
Myth, start there.
Okay.
We'll start with the liquidity piece. It's one of the myths that we continually battle because I have advisors and investors coming up to me on a regular basis, sort of showing me their phones saying, see, this ETF only traded 5 times today, it's not liquid. So 3 issues around that. One, they're showing me maybe the trading that's on the Toronto Stock Exchange, and in Canada there's multiple exchanges.
Right,
so
you've got the Canadian Securities Exchange,
you've got the NEO,
the Toronto Stock Exchange.
And then some smaller ones. So you're only seeing a piece of the activity. 2, you're only seeing one part of the liquidity. There are 2 pieces of liquidity for ETFs. There's primary, that's what you see on the stock exchanges.
Okay, so explain that in detail. Primary.
So primary is when you see buys and sells on the exchange. So you put in a trade for I want to buy 100 units, and then somebody conversely sells 100 units, and it's a wash. Below that, though, is called secondary liquidity. And that's the more important piece of liquidity because that is the liquidity of the portfolio, the components of that portfolio.
The ETF portfolio.
Right.
Okay.
So you've got the ETF that trades, and then beneath that you've got the portfolio. So the issue is what's in the portfolio, can somebody buy and sell the stocks that are within that? If the components of that pool are illiquid, that may make it harder to grow or shrink the pool.
So I just want to backtrack. Illiquid means you cannot buy or sell it, or you're having a hard time buying or selling it.
Exactly. So, but that in itself is an issue that the industry has been aware of from the very beginning. Therefore, they have partnered with firms on the brokerage side that they call market makers or designated brokers in Canada. They are contracted to ensure there is a market.
Okay.
So as long as you're not crazy with the price you want to buy or sell your units at, you can put your trade in, and very rarely is it another investor that's buying or selling your side. It will be one of the market makers to ensure there's always trading.
Right.
And then the other piece is they are responsible for ensuring that the bid price and the ask price is as close as they can. So There's people out there that are professionally contracted to ensure that there is a market and ensure that there is liquidity in the market.
So you hear a lot about the fact that ETFs are low cost. They are much lower to purchase, lower cost than a mutual fund, but that's not always true.
No, I mean, it's like any product. So the passive products, which are the larger and the older products,
right,
that may track an S&P index. So they are called index tracking because that's all they do. They pick an index like the S&P, the Dow Jones, the TSX 50, and they track that as close as they can. So those are very inexpensive. Those are maybe between 6/100ths of a percentage point to 10 or 12. So it's really inexpensive.
And that's the passive.
Those are passive, and they're large, and they've been around a while. A lot of the products that are launching now are active. So they're very much like a mutual fund. There may be a portfolio manager that's trading them, or they've taken what is another term that's very common out there is factor-based ETFs.
Okay.
Smart beta is the other term. They've taken an index and they said, well, we like the S&P 500 as an index, but we want to take away the most risky of the products. So we only have the least risky 100 products in our portfolio, and those are called factor-based. So they may be active, but there's no human touch. It's all computer motion. Okay. Those are going to be a little bit more expensive because there's people involved in the management. So the average active or equity product on the ETF side is about 36 basis points, or 36% of 1% of the cost. On the mutual fund side, it's about 1.8, I believe. Okay. Now that includes the commission that the advisor gets. So whereas most people say it is cheaper, guaranteed the product itself is going to be cheaper, but our product doesn't include the commission. So you do have to be very well aware of the full cost of ownership of any product.
Right.
So you can buy the ETF, but if you're dealing with an advisor, there is going to be a commission and maybe a trading cost on top of it.
And what if you're doing it online?
Online, there still will be some trading cost, but it would be substantively less than a mutual fund.
Okay, well that's good to know. Pat and I will be back after the break to talk more about ETFs here on Finance is Personal. Welcome back to Finance is Personal. I'm Liz Naumovski. Today we're learning about exchange-traded funds, or ETFs, with Pat Dunwoody, Executive Director of the Canadian ETF Association. Pat, you exude ETFs. This is your thing, right? You're so good at explaining it to everybody. So why, you hear about ETFs and everybody talks about their new popularity and you hear about them being so popular, but they've been around for a really long time.
In fact, they launched in Toronto 30 years ago next March.
Yay, Toronto.
Yeah, yes. It was TIPS, and it's morphed into a different product, but it still exists. I was there when it launched, and it just never caught on because our industry, historically, it's changing a little bit, has been one of those industries that is commission-based in accounts for clients and very much sold by the advisor to the clients. And we have never been, as a Canadian population, very fee conscious. So that's very different than the US. So in the US, the ETFs caught on very quickly, and it's a large part of their financial services market now. Up here, we still are about 12% of the mutual fund industry, but it's growing every year. Last year, so 2018 was the first year that the flows into the ETF industry were more than the mutual fund industry. So I think the investors and the advisors are finally starting to see how ETFs can be used in portfolios.
So why do you think they become so popular now?
So there's probably two streams. One, institutional investors, so those are sort of the pension funds and foundations. They don't have the money or the bandwidth to be able to reach out into different geographic areas, or so it's easy for them then to buy Japan ETF or something to get in and out very quickly. So they've taken on a big piece of it, and on the bond side too. with the interest rates so low, it's very difficult to buy and sell individual bonds. So they can go in and out of a bond ETF very quickly when they need to. On the retail side, I think people now getting close to retirement with interest rates so low, again, you have the 60-40 portfolio quite often, so you've got 40% maybe in bonds.
Right.
Interest rates are almost zero. So I think clients are finally becoming very fee conscious and asking their advisors what is the fee, and if they can get a less expensive product, they are doing that. And then I guess tied to that retail side is certainly the millennials who want to do everything on their phone.
Right.
And you can do that with an ETF, but not necessarily a mutual fund.
I find it really interesting. I was talking to someone at an event, and they work for like an accounting consulting firm, and they were saying that they can only invest in ETFs, and they can't invest in specific stocks because a lot of the times they're consulting on the company
right.
stocks that are available. So I thought that was really interesting, and I'm not sure whether that's a known fact or not.
It is. I mean, it would be a conflict of interest, right?
Right.
So you can't, and there could be insider trading involved. So ETFs allow you to invest in a sector that you know very well as a consultant, but that you're not targeting specific companies.
Right now, there seems to be a lot of companies that are starting and launching ETFs. Mm-hmm. And, it was very slow in the beginning. You only had, the top 3 or whatever, mm-hmm. but there seem to be quite a few right now.
It is. When we launched the association sort of early to mid 2012, there were 6 ETF providers and about 200 products. As of the end of last month, there were 37 providers and just over 700 products. Most of the mutual fund companies now in Canada have ETFs. The banks have ETFs now. Some of the insurance companies are launching them. Sometimes as a defensive strategy, just in case a client asks, they can offer it. Mm-hmm. But I think they realize that the tide is turning, and so they need to be able to market the product in replace of mutual funds.
So we've talked about the association, the Canadian ETF Association. Why don't you tell retail investors, viewers, of why it was created and the importance of having the association?
Sure. So when it was started with 3 ETF providers. They didn't feel they had a voice in the financial services industry, and they wanted an ETF-only voice. And when we started it, that's sort of was the main reason. Policy issues that haven't really been an issue. We've discovered over the last 5 or 6 years, though, it's all about education. So we are targeting, we don't have obviously the money to educate investors other than things like this and some magazine articles. So we really do target advisors and try to get them to understand not only what the product is, but how to use it effectively in their clients' portfolios.
I think it's important. I think education is really important because it doesn't matter whether you're male, female, what your age is. When you don't work in a specific industry, you feel very intimidated by it. We're great in our industry, but we're not going to be so great in somebody else's industry.
Exactly.
And I really love the fact that I've had the opportunity to do a show like this where we can showcase different aspects of the investment industry and educate people, but also associations like yours who are actively trying to educate people and help them along the way.
It is. It's important. I mean, we don't want people to have a bad experience with the product. So we want to make sure that if you're buying the product, the products are great, but that you trade them properly and you don't make mistakes doing that, because it will leave a bad flavor in your mouth, and we just don't want that.
No, well, nobody does. And I also heard that there is a women's association for ETFs.
There is. Women in ETFs started 5 years ago. Actually, next month we have a 5-year anniversary. Started by a few women in the US and the UK. Specifically because it was such a growing industry, they wanted to ensure that people knew about it, not just women, but people, but to help women help other women climb their career within the industry. So right now it's global. There's chapters in Europe, Asia, all over the US. The Canadian chapter's in Toronto. We've got about 400 members in our chapter, and there's about 4,500 global members.
And there's a chapter in Toronto?
Yes.
I think it's really important because I think it's important to mentor women.
Absolutely.
And You know, it's important to give them a voice and help them climb that ladder, because it's such a male-dominated industry, and that's one of the reasons why this show was created, to help advance women and educate them. And, you know, kudos to you for knowing that this is really important and putting it out there.
Well, and we've got about 25% of our members are male, because it's pointless to try to help women if you don't have men assisting that. But it's our industry, I have to say, because maybe it is new-ish, there's huge support. It doesn't really matter, male, female, young, old, it's who can do the job.
That's awesome.
Because it's so important, and so many of the companies are so small, you have to do multiple jobs. So it really comes down to a generalist, so it's great.
That's awesome. We'll be right back after this break to learn more about ETFs with Pat Dunwoody. Welcome back to Finance is Personal. I'm Liz Naumovski, and joining me today is Pat Dunwoody, Executive Director of the Canadian ETF Association. Pat, there's one thing I really want to talk about is knowing your product. A lot of people talk to their friends, and their friends will say, I've invested in this is fantastic, you should do it as well. And I'm really, really big on know your product. I want to quickly talk about double up, double down ETFs. Because you think of double up, you think you're going to make a lot of money very, very quickly, but that's not the case.
Well, it could be the case.
It could be.
But I always tell people, like, unless that's your full-time job, or you want it to be your full-time job, and so you really know every product you're going to invest in, and you know yourself. Because you have to, the whole behavioral finance piece, you have to be able to control your emotions and get in and out at the right time. Those vehicles that you mentioned, those we consider trading vehicles. We don't consider them really investing vehicles. You have to get in and out. They rebalance every day. So where you think this is great, I'm going to make a lot of money in a week, well, you won't, because it sort of flattens out at the end of every day. So people think they know what the products are, but there's so much information out there on ETFs that it's easy enough to get a high view of them, and there's things called Etf Fact Forms for every product, and on that it will tell you what the risk rating is. So if you see something that says high, it's a pretty good one to stay away from.
Well, because investing is supposed to be for your future, for the long term. And it's funny, years ago I interviewed somebody, his name escapes me right now, but he talked about day trading. And so these double up, double downs are very much like the day trading.
Yes.
And he said to me, if you took $50,000 US and took them out of a paper bag and laid them on your front lawn and set them on fire, would that upset you? And if the answer is yes, then day trading in very, very risky stock or very, very risky investments are not for you.
Exactly.
So now let's talk about debunking the myth. I know that you and I were talking about different myths that are surrounded around ETFs. So if you could just go through all of them and explain what the myths are and what the truths are.
Well, we spoke earlier about the liquidity myth,
Right.
so we can leave that. Another myth that is out there is that ETFs crash the market, or could crash the market.
I have heard a lot of that lately.
So if you think back, we've only been around for 30 years, so there were a lot of crashes before 30 years, so we weren't part of those. But really, we are like a stock in that respect, that we follow the market as opposed to creating the market. So if the market does some crazy things, so if there's an impact, something is said in the US that makes the market go crazy,
Right.
or investor sentiment changes on one area or not, ETFs are going to follow the market. So if the market goes down, ETFs will go down. It's not the other way around. I guess the other aspect of that is the size of the industry. Again, we're only 10% of the mutual fund industry in Canada, and globally, ETFs only represent about 5% of the overall equity market.
Isn't that much?
So even if you thought we did, 5% is not going to change a market very much.
Right. What other myths are there that people should be aware of?
A lot of it does come down to the liquidity and just knowing your product, right? It's making sure you know what you're investing in and that it is for the long term. And we aren't going to move the market. We're not going to be a terrible product if people aren't buying it and selling it. Because the other aspect is too, we said we've gone from 200 to 700 products in maybe 10 years. Some of them are quite small. They're great products, but it takes them a while maybe to gather assets. So there may not be a lot of trading on a daily basis.
Okay. Now, if you had one piece of really good information to share, to offer someone regarding investing in ETFs, what would that be?
More tactical. So one, we've stressed the knowing your product. Absolutely know your product. And because they are popular right now, you can Google and find all sorts of information. The ETF providers also have a lot of educational pieces on their website because they know that's a big part of what they have to do. Our association is just launching a big push on webinars, so an educational portal that will be in place in a few months. Again, just a central place where people can go and watch a 20-minute webinar on certain products or certain pieces of the industry to really learn. The next piece are the sort of the tactical. Mm-hmm. So if you are trading an ETF, don't trade the first 15 minutes of the day, because that's when, if something has happened overnight, there may, there's different time zones, there may be some major events happen overnight that will cause changes to the market, mm-hmm. but they happen before the market opens. So during those first 15 minutes, the stocks that are impacted by those changes, we call it price discovery. Okay. So it will settle down in terms of the price that the true value of it. But you figure there may be 100 stocks within an ETF. So you've got 100 stocks that have price discovery. So during those 15 minutes, you really don't want to buy because it may not be a true representative price.
Interesting.
And the last 15 minutes of every day, again, stay away from, because that's when the professional traders and others, maybe they have trades pending and they just want to get out. So again, it may not be a representative price. And last on trading is we don't recommend people using market price to use a fixed price. So you go in and you actually choose the price you want to buy the product at, because it's too risky to use market.
Now, before we close, if someone wanted to use their online brokerage account to purchase and sell ETFs, what trading advice would you offer them?
What I've said, for sure.
Okay.
And a lot of it comes down to knowing what you want the product for, right? So if you're buying it into your RSP, look for those long-term buy and hold products, just the same way you would look for a mutual fund. Buy it to hold it. If you're looking for something for a 5 or 10 year period, or 3 to 5 years, again, you may be wanting to be a little bit more cautious, because you don't know what's going to happen in the next 3 years, and if you need a specific amount of money, you don't want to risk it.
So we've got 1 more minute left. What words of wisdom would you like to share with anybody out there in retail that has been afraid to invest in ETFs?
So if you're with an advisor, or even if you're not, I think it all comes down to partnership. A lot of advisors aren't using ETFs yet. We only have maybe 8% penetration into retail, and still a lot of advisors aren't using it. And that's a whole business model change. But I think clients have to talk to the advisors about the products, one. And I think starting to really educate yourself. I don't want you to become a day trader. I don't want you to become the expert, but you need to know enough about the product to ask questions to your advisors so that they can partner with you for your future.
That's great. Thank you, Pat. Exchange-traded funds have revolutionized the investing industry by making it easier than ever for investors to get exposure to the widest possible range of investments. Investing in ETFs can either boost your long-term gains or create a volatile portfolio, but like any financial investment decision, it's important to do your homework beforehand. Take the time to learn how ETFs can help you achieve your investment goals and which ones are risky. I'd like to thank Pat Dunwoody for joining me today, and you, our viewers, for watching. For more information about our show and to view past episodes, log on to financespersonal.ca. I'm Liz Naumovski. Bye for now.